In 2023, Orlando ranked among the hottest housing markets in America. Now in 2025, listings have soared over 44%, prices are flat, and some neighborhoods face the highest inventory since the last crash. As of March 2025, there are 8,396 single-family homes and 4,418 condos, townhomes, and villas available. The spike is not limited to a single area. Osceola County, for example, has doubled its listings since 2023, with neighborhoods like Poinciana and Cross Prairie now reporting inventory more than 75% above the metro average. For anyone searching for a home, the difference is clear. There are more choices on the table than at any point since 2008. The question now is whether this unprecedented supply will force prices to move, or if sellers will continue to hold their ground as the market recalibrates. Orlando's median home price has hovered around $375,000 since January 2025, a figure that barely budged from its level a year earlier. This price plateau isn't a sudden development. It is the result of 3 years of near-flat growth, with the city's housing market stuck in neutral ever since the post-pandemic surge faded. The numbers tell the story. In late March 2025, the median price for a single-family home dropped 3% in just 1 week to $410,000, while condos and townhomes saw an even steeper weekly decline of 5.8%, landing at $268,500. Seasonal slowdowns are part of the picture. Home sales fell sharply from December to January, tumbling from 2,154 to just 1,514, a 29.7% drop according to the Orlando Regional Realtor Association. While January is always a quieter month for closings, this year's dip was deeper than usual, underscoring the hesitancy among buyers. With prices essentially unchanged for 36 months, the usual spring bounce has lost its punch. This long-running standstill has started to shift the balance of power. Buyers, once outnumbered and outbid, now have more leverage at the negotiating table. Sellers are no longer fielding a rush of offers above asking price. Instead, many have to reconcile with a new reality. Homes are sitting longer, and weekly median prices are swinging downward. The flat line is giving way to small but telling corrections, as demand continues to pull back and buyers grow more selective. Investor activity in Orlando has dropped off a cliff. In 2021 and 2022, investors poured into the market, snapping up homes at record prices. But by 2025, investor purchases have fallen 62% from their pandemic peak. That retreat is not just a statistic, it is showing up in real losses. One investor who bought a home in 2022 for $550,000 ended up selling in March 2025 for $391,000. That is a 28% loss, after months of sitting on the market and several rounds of price cuts. Stories like this are no longer outliers in neighborhoods thick with investor-owned properties. The pressure to sell, combined with rising costs for insurance and property taxes, has forced some investors to cut their losses and walk away. These loss-driven sales are starting to shape the entire market. When a property sells well below its previous price, it pulls down the value of surrounding homes. Appraisers use these lower sales as new benchmarks, making it harder for other sellers to justify higher asking prices. For buyers, the power dynamic has flipped. One Orlando couple negotiated $25,000 off the list price on their new home, plus closing cost credits, concessions that would have been unthinkable during the bidding wars of 2021. As more investors offload properties at a loss, buyers are gaining leverage, and the definition of a fair price is shifting week by week. Orlando's rental market is experiencing a dramatic turn. In the first half of 2025, nearly 8,000 new apartment units hit the market, pushing vacancy rates up to 7 or even 8% across the metro area. Landlords facing more empty units than at any point in recent memory have responded with a wave of incentives: 1 month free rent, reduced security deposits, and even gift cards for new tenants. Renters who once struggled to find an affordable place are now fielding offers. In Lake Nona, a recent tenant moved into a modern complex with a $750 deposit waiver and a free month's rent, enough savings to furnish their new home and set aside money for emergencies. Stories like this are becoming common, especially in higher-end developments near Disney and downtown, where property managers confirm that at least 1 in 10 leases now comes with a sizable concession. The numbers tell the rest of the story. Rents in many neighborhoods have dropped by 15 to 20% since the start of the year. According to CoStar and Yardi, units that once rented in days are now sitting vacant for 30, 60, or even 90 days before finding a tenant. Vacancy boards and leasing offices are filling up, and landlords have little choice but to sweeten the deal. For renters, the pressure is finally off. The surge in supply has shifted the balance, giving tenants more choices and a rare chance to negotiate. The relief is real, and for many, overdue. Nick Gurley, a prominent housing market analyst, draws a direct line between Orlando's current trajectory and the conditions that preceded the 2008 crash. He points to the sheer scale of inventory, now at its highest since the last downturn, and warns that if demand fails to rebound, the city could face a years-long slide. According to Gurley's models, Orlando homes are overvalued by 18% compared to long-term historical norms. His forecast calls for a 6% drop in metro area prices over the next year, a sharper decline than most national projections. The risk, he argues, is amplified by a wave of investor-owned properties hitting the market. If too many investors try to exit at once, the resulting flood of listings could force prices down even further, just as it did in the last real estate cycle. Gurley's analysis suggests that Orlando's fate now hinges on how quickly this excess supply can be absorbed, and whether buyers return before negative comparables and forced sales trigger a deeper correction. Mortgage rates, which soared near 7% in 2024, have now drifted below 6.3%, a shift that is quietly reshaping the mood among buyers and sellers. Lower borrowing costs are beginning to draw some interest back to the market, especially from those who had been sidelined by last year's affordability crunch. Yet many homeowners remain hesitant to list, preferring to wait rather than accept prices below their expectations. In Orlando, about 28 homes are withdrawn for every 100 new listings, a figure that sits well below Miami's 59 and Tampa's 33, according to Redfin Analytics. As Orlando's housing market resets, buyers and sellers face a new reality: surging inventory, flat prices, and affordability pressures. What happens next won't just shape property values, it will define who can call this city home.